Crypto as an asset class is highly volatile. It's for people with a high tolerance for risk and who understand they can lose the entire value of their investment. Crypto may be more susceptible to market manipulation than securities. It's also not insured by the FDIC or protected by the Securities Investor Protection Corporation. Investors in crypto do not benefit from the same regulatory protections applicable to registered securities like stocks or bonds. Fidelity Crypto is offered by Fidelity Digital Assets. Brokerage accounts and securities trading are provided by Fidelity Brokerage Services, which does not offer crypto as a direct investment or provide trading or custody service for such assets. Throughout this interactive conversation, you'll hear us use words like cryptocurrency, Bitcoin, Ethereum, and many more. We may use terms like crypto or digital assets as substitute words for specific coins, or to talk about the ecosystem as a whole. Just remember, all coins and tokens have very different attributes and use cases, and the ones we talk about here are only part of a wide variety of digital assets in existence. Hey there, welcome to the Covering Crypto live stream. I'm Jim Armstrong with Fidelity. You know, it's pretty common to hear the word crypto or cryptocurrency used as a synonym for Bitcoin. So it's common, but it's also a mistake. Cryptocurrency, that's an umbrella term under which so many different cryptocurrencies fit, including Bitcoin and almost countless others. All of those different coins and tokens, all of those different cryptos, each have their own distinct use cases, value propositions, maybe different technology backgrounds, different potential futures, which is why it's really important to be able to distinguish between and among all of them, which is what we're going to spend a lot of our time today doing. We're going to focus on the 4 cryptocurrencies available for trading with Fidelity Crypto, and those are Bitcoin, Ethereum, Litecoin, and Solana. So to have that conversation, we are thrilled to have a couple of fantastic guests join the panel, Max and Matt, both of whom have been on the show before, but it's been a minute. So it'd be great if you could just introduce yourselves real briefly to the audience, tell them a little bit about the work you do here at Fidelity. And Max, we'll start with you if that's okay.
Yeah, this is awesome, Jim. I love this topic and thanks for having us. Hi, everyone. I'm Max Waddington, been a research analyst with Fidelity Digital Assets for about 3 years, and I've spent 7 total years with Fidelity, like the broader firm. I'd say the biggest role that our research team plays is really just educating our clients, our institutional clients, helping them get comfortable about this industry, giving them what they need to help them understand whether it's data, research, analysis. I specifically focus on Ethereum, Solana, other smart contract platforms. So that seems to fit pretty well. And I'm hoping we get some good questions to maybe help some other folks along their learning journey today.
Yeah, sounds great. And Matt, how about you?
Yeah, it's great to be here. I'm Matt Hogan. I'm also a research analyst for the Fidelity Digital Assets team alongside my colleague Max Waddington. And hopefully I can help be a good complement today because I focus more on the Bitcoin side to Max's Ethereum and Solana. But as Max mentioned, we focus on really helping institutional clients better understand the digital asset ecosystem that is emerging. And we do this really by helping break down the headlines, providing analysis on what's moving the markets, and really try to help bridge the knowledge gaps that exist between traditional asset managers and the digital asset space. So, definitely excited to be here today and really looking forward to the conversation.
The 4th member of our team is Kelly Allen. Her day job is working on our educational team, but today for the live stream, she's going to help our live audience navigate the interactive parts of the show. Hey, Kelly.
Hey, Jim. Happy to be here.
All right, let's start off with an agenda, give people a sense of what we're going to be talking about today. We'll spend the first 5 or 10 minutes or so doing a bit of a compare and contrast, looking at the 4 coins that I mentioned at the top of the show. And then we'll do a bit of a deep dive into each of them. We'll start with Bitcoin, move on to Ethereum, then Litecoin, and then Solana. And then we will take as many live questions as we have time for. We have a couple of great questions that came in from people who registered for the live stream that we thought would be an opportune way to start off the conversation. Charles wants to know if Bitcoin is the same thing as crypto and what's the difference between them. Nathaniel's got a slightly more nuanced question. What's the difference between Bitcoin, Ethereum, etc.? Aren't they all just cryptocurrencies? Why would one be more valuable than the other if they all have the same characteristics? So, Nathaniel, that question is really going to shape the entire live stream today. Charles, as I mentioned at the top of the show, you're not alone in thinking that Bitcoin and the word crypto are synonymous, but they're actually not. Crypto is the larger term. Bitcoin is a cryptocurrency. All cryptocurrencies that are not Bitcoin are collectively referred to as altcoins, short for alternative coins, as in alternatives to Bitcoin. But Max, I'll turn it over to you now to talk a little bit more about Bitcoin specifically, since it does tend to be, I think, the place a lot of people start to learn about crypto in general.
Yeah, absolutely. To Nathaniel's question, I sure hope we get to all of the, like everything under the sun. There's so much there. But to start off, that is something you hear. And I like how you kind of started with that intro of making that difference. On our research team, we've always said start with Bitcoin when it comes to your learning journey because it's the simplest, it's been around the longest. And while understanding Bitcoin, can help you get a better start or a better understanding of the rest of the space. There is, that common misconception that I hear, like you pointed out, that like all cryptos are just copies or based on Bitcoin. And like you said, that's definitely not true. We typically just refer to everything that's not Bitcoin as an altcoin. And they each come with their own kind of characteristics, so it might not even be fair to group them all together. But just as an example, like some cryptocurrencies or altcoins are used as like payment rails, or others can be used for trading. Like Bitcoin, there can be other stores of value. So it's a wide open ocean here, but that's at least a start differentiating Bitcoin from everything else.
And certainly we'll spend a lot of time talking about Bitcoin, but during this compare and contrast section, Max, you've got a chart that you can help break down the three altcoins that we're going to be talking about today: Ethereum, Litecoin, and Solana. So why don't you just start by giving us a lay of the land there?
Yeah, there's some just pretty basic high level differences that we can start off with. And that kind of provides some interesting context here. We got the first row, we can look at when they were launched, right? Bitcoin being the first in 2009, Litecoin following shortly after that. And I think that time frame was when the stigma or the misconception of everything being based on Bitcoin kind of arose, but now it's completely different. We have Ethereum in 2015, Solana launching most recently in 2020, and Bitcoin is by far the largest by market cap. That's also another reason we just like differentiate Bitcoin and everything else. It currently makes up, I think, around 60% of the total crypto market cap. And when we say market cap, that's just the price multiplied by the number of coins or the total supply in circulation. That's how we're getting that value. Ethereum is number two, still maybe 4 to 5 times smaller than Bitcoin, and then kind of everything else follows with Solana in the top 10, Litecoin in the top 20. So still some pretty notable assets that we're covering today with a pretty wide range, which is why this should be really interesting. I think one of the most interesting points, hopefully we get some questions on this, is it's like supply dynamics here. If you look at Bitcoin and Litecoin, they do have fixed supply schedules. So they have the maximum cap of 21 million for Bitcoin, 84 million for Litecoin, whereas Ethereum and Solana, they have no fixed supply. And that can often bring up a pretty interesting discussion. Hopefully we get some questions on that.
And we'll definitely dive deeper into their use cases in a minute. But another row on that chart, Matt, we're going to turn to you to talk about, which is the consensus mechanism specific to each of those coins or tokens. So start us off by just defining what on earth that is for folks who don't know. And then after that, it's up to you.
Yeah, it's a great question. It's definitely a core concept underpinning these blockchain networks. So it's definitely a good starting point there. But first, it's really worth noting that all of these cryptocurrencies are similar in that they run on what's called blockchain technology. And so blockchain or blockchain technology is really basically just like a digital ledger or database that everyone can see and agree on, where each entry or block, as they are appropriately called in blockchain, is locked in place and linked to the previous one so no one can cheat, no one can spend funds that aren't theirs, or change the historical record of transactions. And so, where a consensus mechanism comes into play here is that a consensus mechanism is really the set of rules that helps a blockchain network agree on which data and groups of transactions are correct without needing a single person or organization in charge. And so that's a really core theme there is that there's no single entity, there's no intermediary, there's no middleman. So you need that consensus mechanism so you can have that agreement without having that third party, really running that database. And so the consensus mechanism is the system that the blockchain uses to choose which computers, or nodes as they are called in this context, get to update and verify those transactions. And there are two main types of consensus mechanisms that we're going to focus on today. The first being proof of work. And that's a consensus mechanism that requires actors called miners to solve computationally intensive cryptographic puzzles. And doing this work helps keep the network secure and make sure those cryptocurrency transactions are valid. And cryptographic here comes from the word cryptography, which is the science and practice of securing information by transforming it into a format that is unreadable to unauthorized parties. So it really keeps that data secure. And this ensures confidentiality, integrity, authentication, and permanence of the data that is contained in that digital database. Now, on the other hand, we have another consensus mechanism called proof of stake. And this is a consensus mechanism that requires actors or validators to bond or stake tokens to validate transactions and add new blocks to the blockchain. And so this works a bit like a lottery system with validators who are randomly selected to check and confirm transactions. Now, Bitcoin and Litecoin are similar in the fact that they use a proof of work consensus mechanism, whereas Ethereum and Solana both use proof of stake, although Solana's version of proof of stake varies slightly from a technical perspective.
All right, thank you for that quick look at how they work. But Max, back to you for what are they supposed to do? We get a version of that question all the time. There's so many different cryptocurrencies out there. Of the four we're talking about today, said glibly, what's the point? What are they there for?
Yeah, it's a good question. Honestly, I think probably the most important question, especially as like non-technical people, not developers, like this is what we can latch on to for like our mental models. What are they actually used for? So if we look at this at Bitcoin first, it's largely known as a store of value, also as a medium of exchange to some degree. And Litecoin, kind of in that same bucket, is almost the opposite. It's focused more on being a medium of exchange, although known as a store of value to a lesser degree, especially relative to Bitcoin. But in this bucket, kind of at the most basic level, both Bitcoin and Litecoin support the basic functionality of sending and receiving value, right? Without an intermediary. That's kind of the whole point, and it's very basic functionality. So we can keep those two kind of in their own bucket. And moving on to Ethereum and Solana, you could say these two are in this similar bucket as well. The core idea is that not only can they send and receive value without an intermediary like Bitcoin and Litecoin, but they allow, or they are tech platforms for decentralized applications. Or dApps, as you'll see there. That's a lot to mouthful, but when we say decentralized applications, we mean that they're decentralized because the applications run on a blockchain without the need for an intermediary. So not only can you send and receive value, you can do other things like trade assets or, make very specific payments, what have you. And then the application piece just means that it's code or what we call smart contracts that are facilitating the activity, thereby removing the intermediary. So those are kind of the two buckets that I would use in our mental models, and hopefully we can kind of get into the nitty-gritty of both of those. But yeah, that's a pretty clean start, I would say. Jim, what do you think?
Love it. Thank you. We'll definitely dive deeper into all of the above. Just worth noting my 2 cents here. One thing that all cryptocurrencies have in common, Certainly, all investments have some level of risk. Cryptocurrencies are on the risky end of risk. There's a relatively high level of risk associated with investing in cryptocurrencies. There are always scams, new ones popping up all the time to be wary of in this space. And even the oldest of cryptocurrencies is still very much subject to wild price volatility. I see a lot of questions coming in the chat now about that exact question when it comes to Bitcoin's very recent price volatility. So we'll get to those in just a second. But in general, if you're looking to get up to speed on topics like that, fidelity.com/crypto is a great resource for you. And you'll hear us mention it a couple more times before this live stream is over. For now, let's focus a little more heavily on Bitcoin itself. We've got a couple of questions specifically about BTC. Chelsea, when she registered, asked us, what's Bitcoin? Can't get more straightforward than that. Norman has a slightly more nuanced question as well. Please explain the intrinsic value of Bitcoin in terms of mainstream utility today. In my words, Norman wants to know, what is this thing and what's it used for? And Matt, we'll turn it back to you.
Yeah, two really important and great starting questions. So thank you, Chelsea and Norman. But I think we should start here with a quick definition of Bitcoin. And there are actually two kind of niche definitions that we're gonna think about and talk about here. And so what we have is Bitcoin, which is sometimes written uppercase or with a capital B, and sometimes with a lowercase b. And the core difference between the two is that Bitcoin with an uppercase B is referring to the Bitcoin network or the Bitcoin blockchain itself, which is essentially just software code that acts as a protocol and creates a payment service. So the Bitcoin network, again with that uppercase B, uses a decentralized proof of work consensus mechanism that we just spoke about right before. And Bitcoin, the network, it's really unique because it is the first time in history that we can send value digitally without intermediaries. And this is a concept known as peer-to-peer transfers. And it is the first open and global payment network. And then on the other hand, we have Bitcoin with a lowercase b, which is referring to the token or the asset that is sent on the network. So Bitcoin with a lowercase b are really just digital tokens that are native to the network and can be treated as a scarce digital asset or aspiring form of money. And these tokens are what can be bought or sold on exchanges and what you will see price quotes for. Now, Bitcoin, the token or asset, is unique because it is the first non-sovereign, non-bank potential or aspiring money, and it is a digitally scarce asset with a hard supply cap and a predetermined issuance schedule. Now, when we put these together, Bitcoin, both the network and the asset, launched in 2009. It was created by an unknown person or group of people by the pseudonym Satoshi Nakamoto. It was the first cryptocurrency that can be transferred peer-to-peer using blockchain technology. And again, focusing kind of on the asset itself is the native cryptocurrency, that lowercase b. That is the reward given to miners for keeping this network secure, and it has that fixed supply of 21 million. So very important there, very, very scarce digital asset. Only 21 million will ever exist of Bitcoin. And so when we put both the network and the asset together, we get the first provably scarce digital asset that can be sent to anyone, anywhere in the world at any given time without reliance on a third party or intermediary. And that is the true breakthrough innovation of Bitcoin.
So Bitcoin, if we listen to what Max was saying a minute ago, was created, invented, introduced as a way to be a medium of exchange and buy and sell things using Bitcoin as a supplementary or replacement currency. But as you mentioned, Matt, it's also often used as a store of value these days. There's a lot of people buying and holding Bitcoin. Help us wrap our heads around Bitcoin as a store of value when it's literally intangible.
Yeah, it's a really great question. And store of value is really a core concept underpinning, Bitcoin as an asset, as you were just mentioning. And I think it's important to start with what a store of value really is. So a store of value really means that people trust this asset will hold purchasing power in the future, meaning it's not going to degrade, it's not going to deteriorate, or it's not going to debase, and it aspires to be a superior vehicle for wealth preservation. And when we say debase here, what we really mean is the reduction in the value or quality of a currency or its purchasing power over time. And so the most common physical example of a store of value would be gold. Now, Bitcoin, on the other hand, is an aspiring store of value because unlike certain other assets, it does not degrade over time. It has that sort of digital durability factor. It is fungible, so any Bitcoin can be traded for another. Just like, Jim, I could give you a $10 bill is good for any other $10 bill. It is verifiable, meaning it cannot be counterfeited. And above all else, it is provably scarce with only 21 million that will ever exist. Again, that's a very, very core component of Bitcoin, that digital scarcity. And so Bitcoin aims to be a store of value against other types of fiat currency debasement. Again, with only 21 million that will ever exist, it has a very hard supply cap, meaning it is very finite in its nature by design, compared to theoretically infinite amounts of fiat money or dollars that can be printed. And so that sort of monetary policy hedge is where its store of value or wealth preservation aspirations come from.
And now what we're going to do with Bitcoin and then all of the other coins we'll analyze is just be honest with the audience. Let's talk about some potential pros and potential cons. What are some good things? What are some potential bad things about each coin? And we'll start with Bitcoin.
Yeah, let's start with the good stuff here. So